Welcome. Group C distributions announced for YieldMax ETFs. Jump into those quickly. Real quick from a macro perspective, looks like stuff's down slightly after the decently down day or down week thus far. Although stuff seems to be coming back slightly. Yesterday, of course, NVIDIA taking 3.5%. Really everything was in the 1 to 3% of the big names, particularly associated with the YieldMax underlying single stock underlying ETFs. Tesla down, Amazon down, as you probably all know. But the news of the day is, of course, the YieldMax Group C distribution. So if we want to take a look at those, let's just filter down to Group C. And of course, I'm not looking at the weeklies, just the underlying ETFs or the single stock underlying ETFs. They do have the new component of this DRAY, which is based on DraftKings. Pretty good performance thus far. You can see their dividend 219, 4.2% of the current stock price. So not too bad. We're almost at a 9-10% return if you would have bought that one at inception. That said, I guess if we want to filter, I like to cover these based on what percent they return based on what the current ETF price is. So basically the recent dividend divided by the ETF price gives you the percent return. Leading the pack, Carvana, $2.56, AMDY, 54 cents, HOOY. It's been a really good performer. Another $3.86 or 5.7% of the ETF price. CONY coming in at 34 cents or just under 5%. DRAY, as we already noted, 4.19%. PayPal, 34 cents, and ABNY, 30 cents, coming at under 2.9 and 2.8% relatively. Netflix, a bit low there at 2.7, and then Microsoft also quite low at 1.8. I'd say low relative to, of course, everything else, and maybe relative to past experience, but not necessarily 2.7 or 1.8% for the month. Not too bad, assuming their underlying equity or the underlying ETF didn't go down too much as well. I do got the ticker here showing the recent prices of the Group C ETFs. Or actually, on the YieldMax page, it's all ETFs. If we want to jump over to Group C specifically, we do got the ticker with the ETFs of just Group C. Those should be found there. Additionally, you can look them up here. As you can see, CONY's up, but other than that, everything else is down. And then also, it was a good idea to tie in the underlying equity. So you can see, I do got the underlying equity, so you can see it compare. Of course, the underlying equity's up, and the ETF's up. That makes sense. But if you're ever curious as far as how PYPY is doing versus PayPal, you can see they're basically the same. PYPY is slight over, or not quite as performing as poorly as PYPY by 0.2 or so percent. Yeah, so I guess that's available. But I guess jumping in, I think the most widely held ETF, or the most popular ones at least for Group C, are CONY, of course, and HOOY. So jumping into CONY here, I will note that if we just look at their distributions relative to past distributions, we do get a pretty low one here. That said, the CONY price is like $7 a share, but the distribution is, I think, an all-time low. That said, as a percentage, it's somewhat close to 5%, so not bad, at least relative to what the current YieldMax ETF price is. If you look at the total return metrics, you can see CONY, we're down definitely from the last earnings report of Coinbase, took quite a stumble, which of course led to the ETF price going from just about 10 down to 7. So you can see in terms of total return metrics, the blue line is shrinking. That said, CONY has been in the 7-8 range before, but the underlying dividend or the cumulative dividend keeps growing. So that's nice to see. As far as a comparison, if you want to see why CONY is back down to 7, you can see Coinbase is doing quite well. Then here's the underlying stock, had that big dip following earnings. This also lets you see how the different comparisons go. So red is the YieldMax ETF with reinvested dividends. Blue, of course, is YieldMax ETF of CONY with no reinvested dividends. And then C is just the underlying stock. So when you do get the big down days, you can see it does hit the reinvested dividend and the underlying stock quite a bit more than it hit the ETF or the ETF price, assuming no reinvested dividends. So much that I guess reinvest your dividends in CONY and not reinvest your dividends in CONY are almost at the same return at this point. The underlying equity, of course, is doing quite a bit better. But I guess the reason why the underlying or the non-reinvested dividends doesn't do so poorly is because you can see this graph is basically assuming no reinvested dividends. So the cumulative dividend becomes a greater and greater percentage of your total return. So when there is a big dip, really just this little blue portion is the thing that adjusts. So if this could get cut in half and really the overall return without reinvesting dividends wouldn't really move too much. So that's probably obvious, but just pointing that out from a visual perspective. And then I guess real quick, CONY, while I'm on it, I just want to look at what they're doing right now from a positioning perspective. Stock is trading up a little bit today, 304. There's synthetics at 320, so the synthetics still at a negative value overall. But they got contracts right now that expire at the end of this week. They start at 318. So I'm looking at this chart, and then they actually got some bought at 328. So really, owners of CONY, we want CONY to run high because we don't really have any capped upside for a long time. And even if we do hit the 318, if you can have it run to 330, we're recapturing upside with this buy. So basically, CONY can basically capture all upside gains of the Coinbase underlying equity going up to about 330. CONY, the ETF, would gain substantially as well with that. So that, I guess, just looking at the positioning, that'd be nice to see. But other than that, they got calls sold 330 to 338, with most of them at 335, and then some more bought up here in the 360 range. Probably outside of possibilities at this point. In terms of how the fund is going overall, you can see they had that there was the big ETF dip, which came following the Coinbase earnings. And then looks like they spent their cash to restructure their synthetic to bring it from not such a negative value up to more of an equal value. Since then, not a lot of movement, just they've been selling their weekly calls and generating a little bit of cash. But that's about everything to say there. Going through the rest of Group C, let's see, PayPal, not a widely held one. Distributions in line. Yeah, pretty standard overall from total return perspective. Not the best fund, but you're up on it. I don't know, just a steady fund as she goes. Jumping into Netflix. Netflix, all the ones with the little arrow, or all the ones with the, I guess I should say the in-depth, or on the left-hand side. I'll probably zoom out so you can't see that on the video, but there's a left-handed menu bar, which if you see the NFLY details, means that I do got the extra data there showing their current positioning and such. But Netflix overall has been a pretty good fund. You see it started with 20. You're almost doubled your money since inception, getting close, or I guess you're getting close to 35. Not quite double, maybe let's say 15 on 20. From a comparison perspective, of course, this is online that underlying Netflix has been doing quite well. So clearly, this is the rank order you would expect. Underlying equity doing best, reinvested dividends doing second best, and just no reinvested dividends doing third best, but not doing too bad, going from 20 to about 34.17. The distribution this week, basically in line with where it's been the last 3 months, 47, almost getting close to the 50-cent mark. I should put an average mark in here. It's probably slightly a little less than average, but basically in line. Jumping into the extra details on Netflix, just specifically looking at the positioning. Netflix is trading at just over 1,200, so slightly below where the line is. Their synthetic's actually at 1,280. The synthetic is negative, and they got calls sold at 1,255. So Netflix is also one that has some room to run before it starts hitting capped upside. I suppose this all makes sense with a few down days to start the week, because clearly they probably set these based on where Netflix was toward the beginning of the week. With it falling, clearly these become further out of reach. So it'd be nice for it to get a snap back, because you'd capture all the upside on the snap back without hitting any of the calls, because you don't hit any of the calls sold until 12.55 strike price. Fund makeup per share, as I said, the synthetic's a little negative because it's below, or the stock price below where the synthetic is structured. So we got a negative 85 cents per share in the synthetic. Other contracts, just a -1, which makes sense because all the calls they sold right now, this other contracts is a representation of what the contracts are worth right now. With Netflix down from where it was and all those contracts structured higher, their market value with only a couple days left in the week is close to basically zero. So yeah, the NFLY is basically trading as the underlying equity is trading for the next couple of days. And then as far as how the fund's been doing over time, not really much here. Synthetics have been gaining cash position. It looks like they've been adding to and subtracting from it just to maneuver their synthetic around, and also it gets added to when they sell weekly contracts. But then it looks like they potentially use a little bit to, you can see where it goes down here. And I don't know, I'd have to see how the underlying equity did, but I'm guessing they shifted the synthetic around a little bit where its strike prices is set. But other than that, not really much going on. Jump to Microsoft quick. I'll just cover them all these today. Feel free to tune out if it's not of interest to you. But as far as Microsoft, they 31 cents, once again, somewhat a little bit low, at least relative to past months. As far as their price plus their cumulative distribution, though, the ETF for the underlying equity has been performing well. So your total return has been going up. Started at 20, trying to get close to 30. This one, of course, not the most volatile one, but as you can see, the stacking the cumulative dividend does add to the total return, which is nice to see. For those who want more of a steady investment with more of a steady distribution, not super high, not super low, but also not having your YieldMax ETF really fluctuate too much. It's started at 20. It's had a low of maybe it looks like it's been in the 19 range for a while, went down to 16, and they're back to 18. So not a lot of fluctuation in terms of the underlying or the YieldMax fund. So a pretty steady investment for those who are looking for something like that. This tab here just shows if you would have started with 100 shares on inception, you'd be up to about 176 shares. So that's for your dividend reinvestment calculations. And then the all variables here, this does a good job of just showing how the fund's price, the MSFO price, has fluctuated over time. Cumulative dividend, of course, is going steadily up. And then purple is your total return, basically adding the blue line and the green line together to get that total return metric. Jump into AMDY, distribution relative to past. Looks like we've been on the uptrend for the last few months. Probably goes along with the AMDY stock, underlying stock price doing a bit better. That said, if you look at the comparison, this is an odd one here with the, I say that because usually the underlying equity does better than the YieldMax funds. That capped upside hits you when the market's really rev higher because you get capped on the upside. That said, that's a trade-off for getting income. In the case of AMDY, when it went down quite a bit in value, you can see the YieldMax no reinvested dividends is actually doing quite a bit better because they had that cumulative dividend that wasn't being affected by the actual underlying equity price going down. So that is one scenario. But then I guess with the AMD snapback in the underlying equity, that is the best approach now between the three compare methods. But I do like to see that. People usually have the question, what performs better, the underlying equity or the YieldMax fund? The underlying equity, if you're in a bull market, will perform better, clearly. But you can see when the underlying equity does decrease, if it does decrease. The YieldMax fund, when you build up a cumulative dividend over time, it does protect you, assuming you're not reinvesting the dividends, of course. It does protect you from some market downside. That said, snapback and equity price can clearly shoot the overall returns of that scenario higher in a fast or short period of time. But price plus cumulative distribution, this is of course your non-reinvested dividends. AMDY is back to 848. It was down to, I think, below 7 even. I guess if we went to the all variables here. Yeah, you can see the underlying equity, yeah, got down to 7, or this is just on a monthly poll, so I don't got the day-to-day stock data, just a monthly snapshot. But yeah, it snapped back. That said, it clearly hasn't snapped back quite like the share price has snapped back, so being on cap on the upside definitely hurt when AMD had that really sharp correction back to or probably shouldn't say correction, really sharp return back up to high stock value on a price per share metric. Okay, jumping to Carvana. Carvana was the best pair in terms of percentage, I believe, yield or the distribution divided by the current ETF price. Overall, the underlying stock is the best option here, but from a distribution perspective, it was 255, which is better than the previous 2 months, but lagging quite a bit on that May, like really good May distribution. From a price plus cumulative distribution, total return since the May has been somewhat flat. It looks like we're back above 60. I think it was assumed starting value of 50. The cumulative distribution was up all the way up to 2045. So you've almost got, I'm trying to do like quick calculation, about 40% of your capital back to you if you would have bought it at inception date. So yeah, that's a good part of these funds. So if you would have invested 50, assuming no reinvested dividends, you already got 40% of your cash back. So this could go to 0 and the most you'd lose would be 60% of your money, assuming no reinvested dividends, but it gives you cash back to do as you wish, invest in what other option fit in the market at the moment. And then I'll do HOY last. So just a quick look at Airbnb. The Airbnb's been, here's the underlying equity price, flat and up and down. Distribution this time right in there with where it's been at 37 cents. Price plus cumulative distribution, this one's paid out a $6.68 cumulative distribution. However, the ETF price has fallen, so more than that. So overall, you're down a bit. Opportunity cost, you're not doing well, but on an overall cost basis, you're down slightly, but you've been staying just about even, close to that 20 mark. Not the best place to have your money, but you're not down too much, not necessarily terrible. Maybe something to consider if you like the prospects of Airbnb going forward. And then jumping onto HOY or Robinhood, very volatile stock as of late, up and down, up quite a bit actually. But so if you would have invested, I think it came out at 50. If you would have invested 5K, all the scenarios are doing pretty well. The underlying, or only the underlying equity, of course, has been the best. From a distribution perspective, it's only paid out 4 distributions. We're at 385. Definitely less than it has been, but still pretty good from a percentage basis. And then price plus cumulative distribution, we already got about a $20.56 payout cumulatively. So once again, if you would have invested at inception date, you already got about 40% of your money back in a dividend or distribution, I should probably say. In terms of how, jump to Airbnb. In terms of how Robinhood's structured right now, wait for this to load. It's currently 104, down a little bit today, almost 105. The synthetic looks like it has been reestablished at 105. We don't have call sold till 113, all the way up to 119. So in the next 2 days, if best case scenario, Robinhood runs to 113 because you basically capture that whole upside with no cap. I wouldn't mind it to run to 115 or even 120. You get capped along the way, but you're still gaining as you go. As far as how the fund is made up per share right now, just a bit above the synthetic, or my last check, it was a bit above the synthetic. Now it's a bit below. So this would probably be negative. Not really much going on. Your cash amount's somewhat close to where your ETF price is. Let me just see if there's anything else. From a synthetic usage perspective, they have, through their synthetic, the right to sell 20,880 calls. They've sold calls against all of it, but they've also bought some upside calls. Or they've executed the credit spread method, where they sell a call and buy a call at a higher strike for 18,000 of those shares, or about 86%. How the fund's been doing, see this goes out to today. Shares outstanding have been somewhat flat for a little bit. Market cap's kind of been trailing up and down. Market cap going up slightly, probably from more shares outstanding, increasing. And then looking at the components of the ETF price, and this of course will adjust once it hits ex-dividend. The cash amount, which is here in blue, will go down by as much as the distribution is, which will also take the ETF price down. But overall, you can see the thing I like to point out here is you can see that synthetic gained quite a bit of value. And what they do is, once a synthetic gains quite a bit of value, they do have the option of reestablishing the synthetic at a higher strike price. By doing that, they can basically sell their current position and take in a bunch of cash and shoots their cash position up, but then takes their synthetic down. So you can see that is quite a bit of a cash addition there. They could have paid a larger distribution, in my opinion, as their cash position went from 56 all the way up to 68, currently sitting about 67 right now. But I think they could have paid a larger distribution. That said, after they pay the distribution, their ETF price won't fall by a ton. Clearly, when you pay those large distributions, ETF price has a tendency to go down by that much. So maybe they want to see some stabilization where the ETF price is right now. So maybe that was their choice as far as paying that. But yeah, those are just a look at some of the components. That is Group C. So thanks for tuning in.